Ladies and gentlemen, dear colleagues, dear friends, on behalf of the Hellenic Association of Insurance Companies, it is my great pleasure to welcome everybody to the webinar series of Insurance Europe's Resilience Week. I'm Alexandros Sarigeorgiou, Chairman of the Hellenic Association of Insurance Companies. This is the first time in the 12-year history of the Insurance Europe International Conference that this event is conducted on a digital platform in line with social distancing norms due to the pandemic. The Hellenic Association of Insurance Companies is proud to support and co-host with Insurance Europe this top-level online event. And although we're happy and grateful that technology allows us to be together in this manner, I will tell you that I would have been much happier to be with you in Greece. It's mostly sunny right now, somewhere nice near the sea. And nonetheless, I'm a bit disappointed that this is happening this way, but nonetheless, it's good that we are together. And before we start, I want to make sure that I tell everyone of you that Greece is open and you should at least come for vacation to Greece this summer. COVID-19 has changed the world in various ways. It revealed the weaknesses of our financial and social systems and triggered an important conversation on how we need to change things in business, in society, in insurance, so that we become more resilient. One of the key lessons of the pandemic is not to take anything for granted and to be always ready to adapt in short order to an ever-changing world. The need to build a sustainable future is important not only for us, but for our children, for the generations to come. And it should be one of our main goals. Resilience is, of course, one of the main issues in our industry, the insurance industry, and therefore it is the theme of this year's Insurance Europe conference. During the pandemic, the insurance industry, as an integral part of society and the economy, is called once again to prove its role as a stabilizing factor. This means that the industry needs to redefine itself and find ways to enhance its contribution to the management of the big issues facing the world today. And it's not only the pandemic, it is climate change, it is natural catastrophes, it is demographics and the challenges facing the retirement systems. And of course, technology is a key factor that is changing the world around us. Starting today and for the next 6 days, we will have the chance to listen to distinguished speakers who will share their knowledge, their experience, and their views on these most critical issues. In a few minutes, the first top-level session of the webinar series, a session entitled Future Resilience, will start. I want to take the chance here to thank all the speakers who will spend time over the next 6 days to share their views with us, and to also thank everybody who is organizing this internet but still major event.
Dear Alexandros, thank you very much for your very inspiring keynote speech, for your kind opening remarks. We are very glad and happy being allowed to be here today with you. And now, ladies and gentlemen, it is a very special pleasure for me and for all of us to introduce to you the European Commission view of Commissioner Mariette McGuinness.
It's an honor to open this year's Resilience Week. And indeed, it's a fitting theme in the context of the pandemic. We've all become more conscious of how major unexpected changes can affect us and the need to plan for and adapt to these changes. Insurance, by its very nature, aims to support resilience in the face of uncertainty. The rationale for an insurance contract is to improve the financial resilience of individuals and companies in case of adverse events. Of course, beyond this, the insurance industry has a larger role to play in increasing resilience, in particular to climate change. Insurers have expertise in risk analysis and long-term financing capacity, which means the sector can support future resilience more broadly. But for insurers to be able to support resilience, they themselves must be resilient. Insurance prudential regulation is key in fostering the resilience of the insurance sector. Solvency II has contributed to building that resilience by aligning prudential rules more closely with state-of-the-art risk management practices. Solvency II, with its risk-based and market-based approach, is seen as a success story. But we should make sure that the framework continues to live up to its reputation. We need to consider the economic environment, such as the new normal of low or negative interest rates, and recent experiences, including shortfalls in supervision or insurers' failures. This means assessing whether the framework continues to be suitable and detecting any gaps or shortcomings that need to be addressed. It also means identifying instances where the framework may be too conservative or burdensome. And it means identifying risks that are not covered enough and recognising capital surpluses currently held by the industry. Following this analysis and based on EIOPA's advice and discussions with relevant stakeholders, the upcoming review of Solvency II will aim to make sure the framework remains fit for purpose. Now I'd like to move to insurers' role in supporting the recovery from the COVID crisis. Insurers have remained robust and offered relief measures to their customers as much as possible, and this is welcome. At the same time, the insurance sector is a major institutional investor in financial markets, whose long-term investment capacity should support the recovery. In order to flourish in the recovery and beyond, EU businesses need access to a wide range of funding sources beyond bank loans. Liquidity support has been essential for businesses, but it has led to higher levels of indebtedness. It's now time to promote equity investments. Insurers with a long-term business model and a major capacity to act as institutional investors should be able to play an important role. The Solvency II review gives us the chance to make sure that we have the right rules in place to incentivise the industry to engage in capital markets. By investing for the long term, the insurance sector may significantly improve the financial strength of businesses and increase their resilience. Another way for insurers to contribute to long-term resilience is by providing life insurance and pension products that can help citizens save over the long run. Often this requires products with long-term guarantees to meet consumers' demands. These products may not be viable if tools to mitigate the impact of short-term volatility on insurers' solvency position don't work effectively. So we will review the functioning of the so-called long-term guarantee measures and the risk margin in the upcoming Solvency II review. Beyond the recovery, the fight against climate change is the greatest challenge of our time. We need to limit the global temperature increase and transition to carbon neutrality. As institutional investors, insurers have huge potential to finance a large part of that transition. We're taking several steps to help insurers identify green investment opportunities. For example, the EU taxonomy is creating a common standard to identify sustainable activities. Corporates of a certain size will have to disclose their alignment with the taxonomy, so potential investors will have more information about a company's sustainability. And the upcoming EU Green Bond Standard will help the identification of long-term sustainable investments. Our society also needs to be resilient to the negative impacts of climate change. Insurers have a key role to play in climate resilience. The industry can support their clients in better understanding the risks underlying their activities or assets, making them think about risks today to be able to withstand losses tomorrow. And this was already acknowledged in the first set of criteria for sustainable activities in the EU taxonomy, where insurance is recognised as an activity that can enable adaptation to climate change. Likewise, insurance was prominent in the Commission strategy on climate adaptation in February of this year. We're preparing a renewed sustainable finance strategy for later in the summer, which will also touch on the role of insurance. At the moment, most of the losses from climate disasters are not insured. So there is significant potential for greater coverage of climate disaster risks by private insurers. The Commission intends to engage in discussions on just how to better use that potential over the coming years. Another fundamental change facing our economy and society is digital transformation, a process that has intensified during this pandemic. The financial sector, including insurers, is the world's largest user of ICT infrastructure. Unfortunately, finance is also the sector most at risk of cyber attack, 3 times more than any other, despite outspending other sectors to protect itself. The security of our financial system is paramount. Our legislative proposal on digital operational resilience in financial services, or DORA, will help to strengthen the resilience of the insurance and pension sectors to cyber attacks. At the same time, digitalisation represents an opportunity for insurers to contribute to societal resilience against cyber attack. We know that the uptake of cyber risk insurance is growing, and it is accompanied by growing awareness of the need to prevent cybersecurity breaches. Before I conclude, let me highlight the need for pandemic resilience. We need to draw lessons from the pandemic and better prepare for future large-scale disruptive events. In the short term, we need to focus on improving insurance product oversight and governance. The pandemic has highlighted the need for clearer information on insurance products and guarantees offered to consumers, especially for business interruption coverage. Over the long term, we need to consider how to increase resilience to pandemics and similar events. And the Commission is engaged in stakeholder discussions to explore how to ensure better coverage of non-damage business interruption risks in insurance contracts and increase the resilience of our economy against large-scale events. And this includes also an assessment of the insurability of various types of systemic risk. It's a complex debate and it needs time. There are other issues around the uncertainty about the insurance sector's ability to supply better insurance cover against pandemic risks, or whether small businesses can or will want to buy new forms of business interruption insurance in a post-pandemic world. Here again, further technical work is needed. Improving our resilience is a major policy priority right now, and it will stay with us for a while. Many challenges lie ahead. The most urgent one for insurance is to ensure that the regulatory framework improves the resilience of insurers while also supporting the sector to strengthen resilience more broadly. The upcoming Solvency II review is key. We have a lot of work ahead of us, and I'm really looking forward to continuing the discussions with the industry and all stakeholders participating in Resilience Week. I wish you fruitful discussions.
Good afternoon, ladies and gentlemen. Thank you so much for joining us today. I would like to say a big thank you to Adonis Georgiadis for his participation, to Commissioner Merit McGuinness, and to Alexandros Georgiou for providing a great start to the first session of this year's Resilience Week, which is kindly hosted by our Greek member association. COVID-19 has very clearly shown to us the need to increase our own and society's resilience, has highlighted the scale of what humanity can achieve when it comes together over a common cause. And we therefore need to build upon that momentum to increase our broader resilience. And this is what our discussions throughout this week will focus upon. When all of us speak about building resilience, we are talking about protecting people, whether that is in terms of their health, their homes, their investments, or their livelihoods. Any initiatives to build resilience must put people first. And this is about insurance. Building resilience also means facing tough challenges. While we face many, I would like to focus today mainly on 4 of them. Namely, first, tackling climate change and moving our economy, as mentioned before, towards sustainability. Second, making it much easier to people to increase their own resilience. Third, ensuring our societies and economies are really ready for digital age. Fourth, last but not least, future pandemics. Let me start with the climate topic, please. As underwriters of natural catastrophe risks, insurers are acutely aware of the risks posed by climate change. Weather-related natural catastrophes are increasing and can already cause hundreds of billions of euros of damage in one single year. Furthermore, natural catastrophe-related economic losses are estimated to have grown by more than 25% just last year alone. It is therefore vital that actions are strengthened to both minimize climate change overall and, of course, adapt our societies to an already changing climate. And this requires coordinated action involving both the public but also the private sector, including us insurers. Indeed, Europe's insurers already play several important roles here. We provide the protection that allows our citizens and businesses to cope with extreme weather events and can encourage them to build back better. We are, as you know, Europe's by far largest long-term investors whose investments can underpin the transition to sustainability. And we advise public authorities on how best to shape adaptation efforts. So while our industry will continue to play a significant, a relevant role, the overall economy must, as a whole, shift towards a much more sustainable approach. And we must remove any unnecessary barriers that prevent insurers from playing their potential role to the full. So we very much support the European Commission's key policy initiatives, European Green Deal, Capital Markets Union, and of course, Solvency II review. But those three must deliver the right outcomes. For insurers, this includes a significant increase in sustainable assets in which we can invest, taxonomy-related data to help us make good sustainable investments and to report on our progress, and last but not least, prudential regulation that really correctly reflects our long-term business model and restores our international competitiveness. The second topic, following sustainability, is about personal resilience. While tackling the challenges linked to the natural world is crucial, we must also be ready for the other risks which we face. While Europe has developed insurance markets, penetration in some lines and markets are low. And this means that many people remain underprotected against the risks which they face. One way to address it is to make it as simple as possible for people to buy the insurance protection and savings which they really need. And we need European Union to reflect this. And some of them do. For example, the Insurance Distribution Directive works really well. Why? Well, it's simple. Because a lot of effort was made to ensure that this directive reflected the sector that it was intended to govern, us, the insurance. In contrast, other European Union rules do not work. And all of you know the packaged retail and insurance-based investment products regulation. Why it does not work? Because the PRIPS regulation was not designed with insurance products in mind. This is despite the fact that 90% of those products to which it applies are insurance products. And so we now have customers overloaded with a lot of information, but who are still not able to find out about the insurance coverage and other services that our investment products offers. And this makes it harder, if not even impossible, for customers to find out the products that really fit their needs. It's helping people to boost their own financial resilience. I don't think so, personally. We need much better rules that make it easy for people to understand the products that they're buying. And this means going beyond just the price. This is because as we face future challenges, the cover and the protection that products provide will become equally, if not more important than the cost. Topic number 3, you will expect it, it's about cyber. Moving our attention online, COVID-19 has demonstrated how digitalization can help to make society more resilient by allowing some businesses and schools to continue to operate and families to stay in contact. This is great, this is fantastic. However, digitalization also brings risks. To facilitate greater economic and social protection, we therefore need to increase our cyber resilience. Insurers, again, here play a major role. not only by providing a cover, but also by helping clients to avoid cyber risks and then to mitigate their impact should they once materialize. While insurance activity in this area is growing, it is still limited. We have to be that frank. And one reason is that cyber is a relatively new risk and underwriting data available. But there are ways policymakers can help. They should, for example, make anonymized incident data available for insurers to analyze. This would allow us to build a broader understanding of the risks and to tailor our coverage. Of course, insurers also take their own cybersecurity and protecting our own and the customer's data to govern very seriously. It's therefore good to see that the Commission is developing a set of harmonized requirements for us, known as the Digital Operational Resilience Act, DORA, you know what I'm talking about. And as always, though, the rules need to be proportionate, tailored to the risks faced by insurers, and avoid any kind of duplication within other existing rules, such, for instance, as the Network and Information Security Directive. My fourth and last point is about future pandemic stealth. Given our experiences over the last year, we must also talk about how to increase our economy's resilience to future pandemics. And unfortunately, there is no simple and no quick answer to this. While pandemic risks are covered in some business lines, this is not the case in others. This includes business interruption, where, for instance, the risk is simply too great for insurers to bear on their own. For example, and you have read about this, the Geneva Association has calculated that insurers would have to collect annual business interruption insurance premium about $30 billion for 150 years to just cover the global output loss from last year, from 2020 alone. And we are, however, convinced that the insurance sector has a role to play and therefore are committed to working with public authorities to help finding solutions. But at the same time, we need to do this while ensuring stability of our industry for the sake of the policyholders. This is the most important thing. So at the end, what is my very personal conclusion? Overall, policymakers must ensure that the rules they develop actually result in the outcomes they want. So do they want to address climate change and move towards a truly sustainable approach? Do they really want to make it easier for citizens to boost their resilience? Do they want to make it safer for all of us to operate online? And do they really want a strong and competitive insurance to make it safer for all of us to operate online? Do they want a strong and competitive insurance industry that underpins all of those objectives? If so, the right and the perfect time to act is now. So, ladies and gentlemen, thank you for your attention and your interest. I would now like to hand over to Don Forgeron, President of the Global Federation of Insurance Association, who is going to put some questions to Victoria Zapata, Chair of the International Association of Insurance Supervisors. Donna, Victoria, thank you so much for joining us today. Great to have you here, and the floor is yours.
Thank you so much, Andreas, and good morning from Canada. Good afternoon to, I presume, most of you. It's been a cold, damp spring in Canada. Alexandro's invitation to come to Greece is particularly poignant for me this morning, probably a lot warmer. Thank you again, Andreas. I'm really honored to be here and have this opportunity to engage Vicky in a candid discussion around issues that I know will be of great interest to our audience. As we've heard from Andreas and Commissioner McGuinness, insurers can contribute to resilience building in a number of areas: climate, cyber, pension. There's a very long list. And sound, predictable, and trusted regulation plays a critical role to underpin the insurance industry's ability to play its fullest role in creating resiliency. Vicky, supported in her role as chair of the executive committee of the IAIS, is perfectly positioned to have a discussion with me on this topic, so I'm pleased to be here with her. For audience members, please submit your questions using Slido, and I will try and include a couple of those before we conclude our session in about 25 minutes or so. So good morning, Vicky.
Good morning, Don.
anything, Vicky, before I get to my list of questions, anything that you want to either react to, or any opening thoughts that you might have for us?
No, let's get to it. I would just like to thank Insurance Europe and the Hellenic Association of Insurers for hosting the event, and for the very relevant and inspiring comments that we have heard so far on this. They're all very relevant, I think, and current in the minds of global supervisors, to which the International Association of Insurance Supervisors cater. So looking forward to the discussion.
Very good. Well, let's get started. Resilience obviously is a very broad topic. And so my first question is about trying to define what it means for the supervisory community. And so I guess two questions in one for you, Vicky. One, are supervisors more interested in the resilience of the sector, the economy, or both? And also, this is trying to get behind the curtain a little bit. Does it depend on their mandates in their individual jurisdictions as to how they're approaching the answer to that first question?
Yeah, thanks. Very interesting and sort of to some extent conceptual question. I think what most supervisors would think about when they talk about insurance resilience of insurance, they will think, as you said, about the mandates. And I've done a review of the mandates of most of our members, and they're not identical, but broadly speaking, the majority of them, almost all of them, talk about safety and soundness of the insurance companies for the benefit of policyholder protection and for the benefit of fair insurance markets. A number of the mandates, or not all, talk to financial stability, the ensuring that the insurance sector contributes to financial stability, and also some of them, but not all of them, might have regard towards competition and broadly competitiveness. A very small subset might speak about competitiveness. So this is kind of the empirical basis. So given this, I think that from the perspective of supervisors, a resilient insurance market is a market by which policyholders, normal people, and companies that serve the broader economy can buy insurance at fair prices to protect themselves against bad states of the world. And we're just experiencing such a bad state. And the insurers will be there, safe and sound, to pay out when these bad states occur promptly. Now, insurance, fair and resilient insurance markets are a necessary condition for broader financial stability. And financial stability is a necessary but not sufficient condition for economic stability and resilience. So the way that I see it is that insurance resilience is an important contributor to economic resilience. The two come in hand in hand, but economic resilience is much broader than insurance resilience. Finally, a lot of regulators would see that a role of the insurance sector being resilient also means that if bad things happen exogenous to the insurance sector, the insurance sector is there and helps towards smoothing the shocks rather than amplifying them. So take the global financial crisis, for example. In that particular event, we saw certain cases where the insurance sector amplified the problem. They were never the source of the original problem, but they amplified it, they made it worse. And I think that the reforms that we have taken since then are likely to have put us in a better place so that the insurance sector supports broader resilience by helping to smooth the shocks rather than amplifying them. Let me stop here.
Thank you, Vicky. That was very, very helpful. And to build on your the theme of shock takers as opposed to shock makers, which I believe you've described the industry's performance or response to the pandemic in those terms. How do you think we've done so far? How do you think the industry has done through this pandemic? And from the supervisory side, are there any key lessons that you've taken note of?
Yeah, another great question. I mean, the short answer and direct answer is that so far, so good. The insurance sector has not amplified this terrible shock that we have been faced with, and has contributed towards protecting households and companies instead. But my caveat of so far so good is an important one. I think what we have seen in this particular crisis, especially amongst the major developed economies, is an unprecedented government intervention and an unprecedented central banking intervention in terms of monetary support and in terms of fiscal support. The former kept financial markets liquid, the latter cushioned the real economy against what we saw, made unemployment outcomes much less worse than they could have been, and reduced the number of corporate bankruptcies. And all of that, of course, had a positive effect in the financial system overall, and therefore to the insurers. We will see as some of this support might be withdrawn if hopefully by that stage the vaccination program would have been successful, and we won't see large macroeconomic effects. I mean, most economists predict a resilient recovery. But there's still risks that could crystallize going forward. And, you know, we always need to think about the counterfactual. The amount of real economy support and monetary support that we have seen is unprecedented on many measures. We shouldn't sort of self-congratulate ourselves given all the help that we had. That said, the key message is so far so good, both on financial resilience and operational resilience. Although, as I think the Commissioner McGuinness said, but also it was highlighted by others, also the pandemic crisis has highlighted the vulnerability of the entire financial sector, including insurance, to operational risks, including cyber risks. But so far, it's been a success. In terms of lessons for supervisors, with my IIS hat on, I'd say that the biggest lesson has been that all the work that we did post-global financial crisis together as an international community helped a lot us as supervisors to build trust internationally between us. So we were very, very quickly able, as soon as the shock sort of became apparent, to reorganize ourselves in an agile manner and switch towards, if you want, crisis monitoring and sharing experiences and lessons with each other in a very coordinated way. We also used some of the tools that we had developed post-crisis. For example, a global monitoring exercise that we developed as part of the holistic framework to actually monitor what COVID was doing to our insurance firms. And we actually, and that was extremely helpful for all of our community. And we published the results of this exercise as well. And it basically shows, as I said, that so far, so good. The industry has definitely been resilient. Let me stop here.
Thank you, Vicky. And I believe your advice about so far so good is probably very apt. This pandemic, if it's taught us anything, it's our inability to predict the future. And I don't mean 6 months from now, but maybe 6 days from now. There have been so many twists and turns, and I suspect there will be more. But thank you for that comprehensive answer. Just a reminder to the audience to use the Slido link if there are any questions that audience members would like me to pose to Vicky. Vicky, I want to switch gears just a little bit, still on the theme of resilience, of course, but to talk a little bit about climate resilience. And there's no question that it's undoubtedly the biggest challenge that our societies and our economies are facing today. And I know the IIS has done considerable work on this file already and will continue to do so. And I know many jurisdictions around the globe have also done a considerable amount of work. From what you've seen thus far, how do you think the supervisory community can help and support insurers in our intentions and our abilities to do more?
Yeah, thanks, Don. It's a great question. I mean, first to say that I very much agree with you that it's a fundamental and extremely big, possibly the defining challenge for our society, the risks that we face from climate change. Now, within that, the insurance sector obviously has to play a big role. You know, the speakers that preceded me outlined some of the key aspects. And insurers, of course, are basically the business is about risk management and offering contracts to protect against major risks. I mean, they model and risk manage catastrophe risk, and of course, particularly on the life insurance side, they're very well placed to invest on infrastructures that would help support the transition to net zero. But your question is about what supervisors can do. And there, I think it goes back to your original question about their mandates. And I mean, you know, climate risks are risks to the businesses of insurers as well, both physical and transition risks coming from kind of late policy changes. So insurers need to manage those risks that are to them, not to others, not to the customers, but to them. And supervisors have a role to ensure that these risks are well managed. Now, a number of supervisors, including, for example, the Bank of England's PRA, I work there, that's my day job, have issued supervisory policy, supervisory statement about what their expectations are from insurance companies in managing climate risk. The IIS only last week issued an application paper which again goes through the IIS material, supervisory material, our core principles, ComFrame, and actually advises supervisors on how to supervise against these core principles and ComFrame climate risk. And the IIS is currently also working with its financial stability mandate at collecting climate risk exposures from a large range of insurance groups to actually look at how the sector is posed against transition risks and physical risks, and will be publishing the results of this analysis in later in the year. A number of our jurisdictions are doing scenario tests as well. For example, the Bank of England and the PRA are doing a quite significant concurrent climate scenario exercise, again, to look at stressed exposures and how they would behave under different scenarios, for example, of policy transition. And all of that should help supervisors and regulators keep a handle and ensure that insurers can manage the risks that they face from climate change. And by doing so, supervisors and regulators can contribute to the transition to net zero.
Thank you for that, Vicky. You mentioned your day job. With the incredible amount of time and commitment you've made to the IIS, I thought that was your day job. So you somehow managed to figure out 36 hours in the average day as opposed to 24. A couple more areas that I want to touch on. In thinking here of work on digital and cyber. So again, I think still with the resiliency theme in mind, but switching topics just a bit. Which areas do you have in mind at the IIS as you look to develop a regulatory framework for these issues that is future resilient?
Yeah, both of these topics, opportunities and risks from financial technology, insurtech, and also risks, but also opportunities in terms of cyber underwriting from cyber are very much part of our agenda. In terms of what we've been doing on insurtech opportunities and risks, rather than sort of rushing into making standards or setting out expectations, supervisory expectations, what we've done is we've put together a forum of experts from the supervisory community. It's actually chaired by the Monetary Authority of Singapore. Singapore is a center that has done quite a lot on fintech. And they to share kind of challenges and experiences. And what we see is that there is a lot of commonality between the challenges and experiences. To be frank, and here I also speak about from my perspective as a supervisor and regulator in the UK as well. There are the issues around kind of the data that insurers use when in order to which they exploit for various purposes in the sort of insurance chain, supply chain. And sort of the data needs to be of sufficient quality. And at the moment, there aren't sort of common data standards for this. So all of this management is being done by the companies themselves. Then the second area is the models that companies are using in order to take advantage of these data. That include, of course, artificial intelligence and machine learning. And then the third thing is that the outcome of all of this and what it means for the consumer. I mean, overall, it's an amazing opportunity for society because it can increase efficiency, it can reduce costs and therefore premia, but also it can increase inclusivity and insurer penetration. But it comes with risks, because if the data is not well managed, if the models are not understandable and well risk managed, and if then the outcomes won't be necessarily right, and they could lead to exclusion rather than inclusion in certain cases. And these are the sort of broad range of challenges that we face. There isn't yet, I think, a consensus on how regulators should respond to these challenges, because everybody, I mean, the balance that we have to strike is between one where we are supporting innovation because it can increase inclusivity and outcomes for consumers, while at the same time ensuring that the risks are well governed within the insurance community. And that is, I think, the next stage of work that we need to think about. I think in terms of cyber, one thing that we've done already is that we've looked and we published a paper last December, which I commend, on cyber underwriting risks, which is, of course, the insurance companies are uniquely well placed in the financial system to contribute to resilience by underwriting these risks. Overall, there's kind of progress made in this area. I mean, the markets are more developed in certain jurisdictions, less developed than others. The biggest challenge is data, again, and we heard about that, sufficient data. There are accumulation risks that could be present, and a risk that our supervisors are particularly concerned about, a number of our supervisors, is non-affirmative risk, when it's not clear that the insurance company is exposed to cyber in the event that the client experiences a cyber event or not. So again, we're going to be doing further work on cyber underwriting, starting from the findings of this first issues paper. And on more broadly, operational resilience, which includes cyber resilience of the companies from attack. We also have set up a task force that is doing this work and which is working very closely with the Financial Stability Board, because, of course, we don't want to duplicate work that is happening cross-sectorally. And indeed, we want to learn from it and advance it from our companies rather than being in conflict with it. So working very, very closely with the FSB on this.
Thank you, Vicky. I'm going to turn to our audience questions now in the few minutes that we have remaining. One is actually just a comment, Vicky. It says, not a question, but a thank you to Vicky for her continued engagement with Insurance Europe and JAFIA. These relationships are more critical than ever. And if I was able to put a thumbs up next to that one, I would have done so as well. I wholeheartedly agree. You've been very generous, Vicky, with your time over the years. And I think both our organizations and the industry is better for that. So thank you. The audience question, we'll do this democratically. So the audience question with the most thumbs up is the following. Climate risks are manifesting themselves through frequency of NatCats. Beyond mitigation, does the IAIS see a role for supervisors in supporting adaptation measures? An interesting question.
Yeah, it is a very interesting question. It's a fascinating question. We had at our executive committee call earlier this year, we had discussion about kind of strategy on climate. You know, I've discussed about the work that we've already done, the application paper that helps the supervisory community supervise risks that the companies are facing. And I've discussed the work that we're doing in measuring exposures. But the question we were looking at the executive committee is kind of what else? Given in order to contribute in this kind of vastly important topic, and there is, you know, complete consensus amongst the supervisory community that this is a very important topic for insurance regulators. This issue of adaptive, helping adaptation was raised. I mean, my personal view of the answer is yes. I mean, it certainly. I mean, it should prevent. Adaptations could help prevent catastrophes, and insurance companies through the contracts can have a very sort of important role to play there. The question is, what is the role that we haven't yet put our finger on? What is the role of insurance supervisors in that? Certainly, we should not be preventing companies from doing that, certainly not blocking certain activities, but do we have a role beyond that, and how? And I think, to be honest, we haven't yet answered that question.
Thank you, Vicky. It's interesting on the issue of adaptation. Something I actually wasn't aware of, that the Paris Accord gave equal time and attention to the issue of adaptation as it did to mitigation, but mitigation has certainly been the dominant issue, but I think and more in jurisdictions, the issue of adaptation, what's staring us in the face, I think is increasing in importance. Vicky, I'm cognizant of the time, but I do want to give you an opportunity. We've only a couple minutes left, but I do want to give you an opportunity to update the group on a couple of key projects that the IAS has underway. I'm sure there would be interest on an update on the holistic framework for assessing and mitigating systemic risk, and also on the ICS. So it's really unfair to ask you to do that in just a couple of minutes, but I think the audience would be interested in whatever you could say there.
Thanks, Don. I'll try. So basically, the big message on both projects is that despite COVID, we are on track. So we've managed to get back on track. We gave some operational relief to our supervisors and to companies submitting data last year in order to help smooth the shock that we're all facing, but that didn't put us off track. So with this year, we're doing the full kind of holistic framework. Last year, we adapted the global monitoring exercise towards assessing COVID. This year, we're doing the whole exercise, and we are on track. And we're also doing the implementation assessments that we have committed to do to check that jurisdictions have adopted the COMFRAME standards around the holistic framework. On ICS, similarly, on track. We had good participation from the volunteer groups. We're expecting good and even better participation this year, and we're on track to complete the 5-year monitoring period. And let me stop here.
Thank you, Vicky, for that. And thank you so much for joining us today. As I mentioned earlier, you've been very generous with your time. we are better informed as a result of these sessions. And we certainly look forward to more and more dialogue with the IAS. Now, one of the shortcomings of these virtual sessions is you can't hear the audience applause. So my applause will have to stand in for those in the audience. So thank you very much, Vicky. We really appreciate it. So I will close the session. I know there will be more from Insurance Europe on Resilience Week. I look forward. I will be back here again next week, moderating another panel on climate. I'm sure there are many other activities as well. Thank you for joining us today, and look forward to seeing you all again virtually. And thanks again, Vicky. Bye-bye, everyone.